Remember what $100 bought you, say, just a few years back. Maybe it was a good chunk of the week's groceries, filling up your gas tank, maybe some change left over, perhaps even that little extra, something you didn't strictly need but wanted. Now, it feels like you need $120, maybe even $130 just to get the same amount of stuff in your basket.
Yeah.
That feeling, right? That constant sense that your money just isn't stretching as far. It is not just in your head.
No, it's absolutely real. And the data really backs that feeling up quite emphatically, actually.
Yeah.
When you look at the big picture measure, the Consumer Price Index, the CPI, prices across the board have jumped dramatically since the pandemic really started. We're talking about a rise of, wait for it, 23.6% since February 2020. Just let that sink in for a moment. That means to buy the exact same basket of goods and services that $1,000 would get you back then, you'd need around $1,236 today.
Wow.
Yeah. And if you kind of stretch that out across what a typical U.S. household spends in a year, that difference, it adds up to roughly $2,832 in extra expenses over a year.
Just for the same things.
Just for the same things. It's a really tangible hit to the wallet. People are feeling it every single day.
Okay, wow. So $2,800 extra a year. That really brings us right to the core of our deep dive today. There's this force. It's actively chipping away at the value of our money, right? Eating into our purchasing power. So the big questions we want to tackle are, what exactly is this thing making everything so much more expensive? Is it, actually slowing down? Is it peaking? And maybe the most crucial question for you listening right now, with all this going on, what practical steps can you actually take to protect your money, to keep your purchasing power strong?
Right. And to get our arms around these pretty complex questions, we've pulled together a whole stack of insights and analysis. We're looking at research from the San Francisco Fed, which is always interesting, practical advice from places like Investopedia. Then there's the latest data analysis from Bankrate and US Bank, plus some really useful personal finance perspectives from CBS News and NerdWallet. So it gives us a pretty well-rounded view, multiple angles on what's happening.
Okay, let's definitely unpack this. Our mission today is to kind of cut through all the noise, right? Understand what's really going on with prices, and hopefully give you some insights you can actually use. So first things first, let's get the basics down. What is inflation exactly? And why does this, sometimes abstract economic idea feel so personal?
Well, at its most basic level, inflation, as the sources define it, is really a sustained increase in the average price level of pretty much everything, goods and services, across the whole economy over time. The key is that it's not just one or two things getting pricier. It has to be a broad trend.
Right, not just gas prices shooting up for a month.
Exactly. And the direct result of this broad increase is that each dollar you have buys less than it did before. Its purchasing power, what it can actually buy, just shrinks over time.
Like that $100 example. It used to get you X amount of groceries, now it gets you noticeably less.
Precisely. It's that shrinking capacity of your money. And the sources point out there are a couple of main ways economists track this average price change. The one we hear about most and the one that's really relevant for consumers day to day is the CPI, the Consumer Price Index. This basically tracks the prices of a sort of representative basket of goods and services that typical households buy.
Like food, housing.
Exactly. Food, housing, transportation, medical care, all that stuff. And the CPI is important because it gets used for things like calculating Social Security cost of living adjustments, CLAs, and it even influences federal income tax brackets. The sources also note CPI gives a pretty heavy weight to things like shelter costs, housing.
Okay, so that's the CPI. What's the other one?
The other big one, and this is the one the Federal Reserve really focuses on for its policy decisions, is the PCE Price Index, personal consumption expenditures. Now, the PCE index works a bit differently than the CPI in how it's calculated. Well, for instance, PCE tries to account for the fact that if the price of something goes way up, you might switch to a cheaper alternative. So if beef gets super expensive, maybe you buy more chicken. The PCE captures that kind of substitution. CPI doesn't really do that as much. PCE also includes spending done for households, like by nonprofits, whereas CPI is just what households spend directly. And historically, because of these differences, CPI inflation has tended to run a little bit higher than PCE inflation.
Got it. So CPI is maybe closer to that gut feeling at the grocery store, while PCE is what the Fed's officially targeting when they think about interest rates. But let's dig into why this matters so much. It's more than just annoying at the checkout, right? Why does it affect our financial lives so deeply?
Oh, absolutely. It matters because inflation just throws a wrench into almost every financial decision we make. It makes saving money really tough, right? Because the value of those saved dollars is constantly getting chipped away unless your savings are earning enough interest to actually keep up.
Which often they aren't, especially in a regular savings account.
Exactly. And for investors, it means you need to earn returns that are higher than the inflation rate just to break even in real terms, let alone actually grow your wealth. And think about households. When the cost of essentials, food, rent, energy goes up faster than people's paychecks, well, it forces really hard choices about where to cut back. And sadly, as some sources mention, it can push people towards using credit cards just to cover the basics, which can lead to debt problems.
Yeah, that's a dangerous cycle.
It is. And beyond just the dollars and cents, the sources also mention the psychological toll, the emotional cost. There's the stress, constantly juggling the budget, the frustration, maybe even anger, seeing prices go up, that feeling of getting poorer. Even if your income went up a little bit on paper, it just forces this constant mental energy on rethinking plans and decisions. That's a real burden.
Definitely a burden felt by many. Okay, so let's zoom in on right now. Based on the data we have from the sources, what's the inflation picture actually look like? This is as of April 2025 data, right?
That's right, the latest reported figures. And looking specifically at the bank rate source, the overall CPI, that headline number, it was up 2.3% compared to April of the previous year. Now, that's actually a slight dip from the 2.4% we saw in March, and it's the lowest annual CPI rate we've seen since way back in early 2021. So that headline number definitely shows some progress, some cooling from the peaks.
Okay, 2.3% headline CPI, down slightly, lowest since early 21. That sounds pretty good.
It's movement in the right direction, for sure. But there's the core CPI number to look at, too. That's when you strip out the really volatile stuff like food and energy prices, which can jump around a lot month to month. Economists watch core CPI to get a sense of the underlying, maybe stickier inflation trends. And in April, core CPI was up 2.8% year over year. That was actually the same pace as in March. It didn't slow down further.
Oh, okay. So headline inflation is easing, which is good news, progress there. But core inflation, maybe the better indicator of underlying pressure, is holding steady at 2.8%, still above the Fed's target, which is around 2% for PCE inflation, right?
Correct. Their target is 2% for PCE, and core CPI at 2.8% suggests those underlying pressures haven't fully subsided yet.
So what's keeping it sticky? What are the main culprits holding that core number up, according to the sources?
Yeah, the bank rate source breaks this down really clearly. It looks at which categories contributed the most to that overall CPI increase over the last year. And one category just dominates: shelter. That includes rent, obviously, but also the estimated cost of owning a home, what they call owner's equivalent rent, or OER. Shelter costs alone were responsible for, get this, over 3/5, 62% of the entire year-over-year increase in the CPI.
62% for just housing costs.
62%. It's massive. So if you rent or if housing is a huge part of your budget as an owner, you are feeling this inflation much more intensely than that 2.3% average might suggest.
Okay, shelter's the big one. What else?
Food was the next biggest chunk, contributing about 16% to the annual increase. That makes sense. It's a major household expense. And then the third largest contributor, which might surprise some people, was car insurance. That accounted for 8% of the total CPI increase.
Car insurance, really, 8%.
Okay.
Shelter makes sense, food makes sense, car insurance is specific. Where else are the sources saying prices are staying, stubbornly high? Those things that haven't really come down much?
Yeah, there are definitely specific areas the sources point to where prices are still significantly elevated compared to before the pandemic, even if maybe the rate of increase has slowed down a bit recently. Dining out is a big one. Prices for eating at restaurants, getting snacks, that sort of thing, up 4.3% just in the last year. But the really striking number is the cumulative jump since February 2020. The cost of eating out is up a whopping 30% since the pandemic began.
30%. Ouch. That explains why a meal out feels so much more expensive.
It really does. And rent, as we said, is huge. While the monthly increase slowed down a bit from March to April, which is a positive sign, the year-over-year increase is still 4%. Now, that 4% is actually the lowest annual rent inflation rate we've seen since the pandemic started, so it is decelerating. But it's still a significant rise and a major expense for millions of households.
Still a big bite out of the budget.
Definitely. And then there's the whole cluster of car ownership costs. They've become incredibly expensive since 2020. Think about vehicle repairs, up 7.6% year over year in April, but since February 2020, up 56.8%
50-30.
for repairs.
Almost. And car insurance is even more dramatic, up 6.4% last year, okay, but up 55.3% since 2020.
Unbelievable.
It's pretty staggering. And even just buying a car, new or used, while the price increases might have slowed down recently, they're still way higher than before the pandemic. New vehicles are up about 20.6% since February 2020. Used vehicles, up 31.4%. Those numbers really paint a picture, don't they? It makes perfect sense now why my feeling of inflation, or your feeling listening to this, might seem way higher than the official 2.3% or 2.8%. If a big chunk of your money goes to rent, or keeping your car running and insured, or eating out occasionally, your personal inflation rate is just going to be higher.
Exactly right. The overall index is an average, but your personal experience depends entirely on what you buy. NerdWallet makes this point very clearly: your unique spending mix where you live. It all means your personal inflation rate is almost certainly different from that national average.
It really highlights why understanding your own spending is so critical. Okay, so we know what inflation is, how it's measured, where we're seeing it now. To figure out if it's peaking or what might happen next, we need to understand the why.
Wow.
What caused this big inflation surge in the first place, according to the sources?
Generally, the sources point to two main types of inflation drivers that were interacting. The first is what economists call cost-push inflation. This is when it gets more expensive for businesses to actually produce goods and services. So think about rising wages for workers or higher costs for raw materials, oil, lumber, metals, food ingredients, you name it. Businesses often pass these higher costs onto consumers in the form of higher prices to protect their profit margins.
Right, like the cost of wood goes up, so the price of a new house goes up.
Exactly. Or a restaurant pays more for chicken, so the price of your chicken sandwich goes up. That's cost push. The second main driver is demand pull inflation. This happens when there's just a huge surge in demand for goods and services, and the economy can't keep up with producing enough stuff. You sometimes hear the phrase, too much money chasing too few goods. That's demand pull.
What causes that surge in demand?
It can be a mix of things. A really low unemployment rate means lots of people have jobs and money to spend. Strong consumer confidence makes people more willing to spend. Low interest rates make borrowing cheap, which encourages spending and investment. And we definitely saw significant government stimulus payments during the pandemic, plus a lot of pent-up demand. People saved money when things were locked down, then were eager to spend it once things opened up. When demand is really high and supply can't keep up, businesses find they can raise prices because people are willing and able to pay more.
Okay, so cost push is about the supply side getting expensive. Demand pull is about the demand side being super strong. Any other factors in the mix?
Yes, there's a third crucial factor the sources highlight, especially bank rate. Expectations. Inflationary expectations can kind of become a self-fulfilling prophecy.
How does that work?
Well, if businesses expect their costs to keep going up, they might raise their prices now in anticipation. If you expect prices for things you want to buy are going to jump next month, you might rush out and buy them today, which adds to current demand. And maybe most importantly, if workers expect the cost of living to keep rising, they're going to demand higher wages to keep up. Those higher wages then become a higher cost for businesses, feeding back into that cost push inflation. The sources mentioned that surveys after the pandemic showed workers were definitely expecting and demanding bigger pay raises, contributing to this whole cycle.
That makes total sense. If everyone thinks prices are going up, the way they act can actually help make it happen. Okay, so we have these forces pushing and pulling prices up. The main institution in the U.S. tasked with keeping inflation under control is the Federal Reserve, the Fed. What's their role, and what have they actually done about this recent inflation surge, based on our sources?
Right. The Fed is the U.S. central bank, and one of its key jobs is maintaining stable prices. Their official goal is to keep inflation, specifically the PCE measure we talked about, around 2% per year over the long run. Their main tool for doing this is monetary policy, and the primary lever they pull is adjusting the target for the federal funds rate.
That's the rate banks charge each other.
Exactly, for overnight loans. But changes to that rate ripple out through the whole financial system. It influences interest rates on credit cards, car loans, mortgages, business loans, pretty much everything. Higher Fed rates mean higher borrowing costs generally.
And the Fed has definitely been active with that lever lately.
Extremely active, yes. According to the U.S. Bank and San Francisco Fed sources, the Fed went on a really aggressive rate hiking campaign starting in 2022. They jacked up the federal funds rate by over 5 percentage points between early 2022 and mid-2023. That brought rates to their highest level in over 20 years. Now, they did cut rates a bit in the second half of 2024, about 1 percentage point in total cuts. But even with those cuts, the current target range as of May 2025 is still between 4.25% and 4.50%. And the U.S. Bank source really stresses that despite those recent cuts, the overall stance of monetary policy is still considered restrictive. Money is still relatively expensive to borrow compared to history.
And that restrictive policy, making money more expensive, it doesn't hit everyone equally.
Yeah. No. Definitely not. The sources point out it tends to bite harder for parts of the economy that are really sensitive to interest rates. Think about people trying to buy homes. Higher mortgage rates are a huge barrier. Households that carry a lot of credit card debt see their interest payments go up. And smaller businesses, maybe those that aren't super profitable, find it harder and more expensive to borrow money for operations or expansion.
That makes sense. It squeezes those who rely on borrowing. Now, that San Francisco Fed piece you mentioned, they actually analyzed how effective these rate hikes were at fighting inflation. What did they find?
Yeah, this SF Fed research is really fascinating. They built on some earlier work where they tried to separate inflation into two pieces, the part driven by demand and the part driven by supply problems. Economic theory basically says that raising interest rates, monetary policy, should primarily work by cooling down demand. Making borrowing more expensive should lead people and businesses to spend and invest less, easing that too much money chasing too few goods pressure.
Okay, so the theory is rate hikes hit the demand pull side of inflation. Did the SF Fed find that's what happened this time? Did it work?
They found really strong evidence that it did, and maybe historically so. Their analysis showed that the contribution to core inflation coming just from the demand side fell by over 2 percentage points since the Fed started hiking aggressively back in September 2022. And here's the really interesting part. They compared this recent period to other times the Fed deliberately tried to fight inflation, going all the way back to 1969. They found that this drop in the demand-driven part of inflation was the largest decline seen during any of those deliberate disinflation attempts they studied.
Wait, hold on. Larger than the Volcker era in the early 80s, when Paul Volcker famously hiked rates into the stratosphere to crush inflation. The Fed's actions this time were more effective at killing the demand part of inflation than even that.
That's what their analysis suggests, specifically regarding that demand-driven component. It's a pretty remarkable finding. They double-checked this using some other sophisticated techniques looking at high-frequency data around unexpected rate moves. And those estimates suggested that if the Fed hadn't raised rates between 2022 and 2024, core PCE inflation would likely have been about 3 percentage points higher on average during that time. And again, they emphasized the impact was almost entirely on tamping down that demand-driven inflation. So yeah, it seems the Fed's actions were incredibly effective at hitting the demand side hard.
Wow. That's a really powerful confirmation of monetary policy working as intended on demand. But you mentioned earlier that inflation wasn't just demand pull. There was that cost push, supply-driven side too. Did the Fed's rate hikes do anything to help with that part?
According to the SF Fed's analysis, not really, or at least not in a statistically significant way over the medium term, say 12 months. They found basically a negligible impact of rate hikes on the supply-driven component of inflation. They do acknowledge there could be a tiny, maybe temporary cost channel effect, meaning higher borrowing costs for businesses might slightly raise their production costs initially, pushing supply inflation up just a bit. But it doesn't seem to be a lasting or major effect.
Okay, so that adds a really important layer. The Fed successfully tackled the demand beast, maybe more successfully than ever before. But their tools didn't really touch the supply side issues. And the SF Fed analysis suggests that a lot of the overall drop in inflation we saw recently, and maybe even back in the early 80s, actually came from other factors, things changing on the demand or supply side that weren't directly caused by the Fed's interest rate policy.
That's exactly what their findings imply. Things like global supply chains finally unsnarling after the pandemic disruptions, or maybe shifts in the labor market happening for reasons beyond just higher interest rates. These other factors, independent of the Fed's actions, likely played a very large role in bringing the overall inflation number down from its peak.
Okay, that gives us a much more complete picture. The Fed did its job on demand, effectively, but other forces were also at play, helping to ease the overall pressure. Now, just as we're getting a handle on the causes and the Fed's impact, some of the sources throw a new curveball into the mix. A new factor adding uncertainty, especially about where inflation might go next: tariffs.
Yes, tariffs. This comes up as a potential new complication in the analysis from U.S. banks, CBS News, and also Facet. Recent trade policy actions and discussions, specifically around higher tariffs being implemented or proposed by President Trump, are raising concerns about how they might push inflation back up.
How so?
Well, the CBS News source points to surveys from back in February where businesses, manufacturers, service firms were already saying that stiffer U.S. tariffs were a key reason they expected their own operating costs to rise. And if their costs rise...
They're likely to raise prices for consumers. Back to cost push.
Exactly. And economists are already trying to quantify this. Goldman Sachs, according to CBS News, updated their forecast. They now think core PCE inflation could hit 3% this year with these tariffs factored in. That's up significantly from their earlier prediction of 2.1% without the tariffs. And Facet put out an estimate suggesting these tariffs could cause an initial jump in consumer prices of maybe around 1.4% directly.
Now, the sources are careful here, just reporting the policy and the potential economic effects neutrally. President Trump has put some new tariffs in place, raised others, like on certain goods from China by 10%, talked about reciprocal tariffs. He also recently suspended some others, like the 25% ones on Canada and Mexico. The sources seem to agree that this policy area is pretty fluid right now, which makes it hard for businesses to plan.
Absolutely. That uncertainty is a key theme. Facet notes how hard it is to make precise predictions because things keep changing. For example, they mention a proposed very high tariff on certain Chinese goods was recently paused, dramatically changing the potential impact overnight. Future trade deals could shift things again. So businesses are struggling to figure out their supply chains, their costs, their pricing, when the rules of the game might change.
Are there related policies mentioned?
Yeah, the sources also touch on how tighter immigration restrictions could potentially add to inflation. By reducing the available labor supply, it could make it harder and more expensive for businesses to find workers, possibly leading to higher wage pressures, which, again, feeds back into costs.
Okay, so summing up the tariff effect. The most likely impact, at least in the short term, seems to be higher prices for consumers as companies pass on those increased import costs.
That seems to be the consensus from the sources, yeah. Retailers like Walmart were cited by Facet as likely passing costs on. But the full, longer-term picture is really murky because the policies themselves are still shifting, and we don't know exactly how businesses and consumers will ultimately react. There's also the possibility that tariffs could slow down the whole economy, maybe even increase unemployment. And that could eventually put downward pressure on inflation, but obviously comes with its own set of problems.
Right. A lot of moving parts and uncertainty there.
Okay.
Let's try to bring all these threads together. We have the latest data showing headline inflation slowing but core sticking. We have the history of demand pull and cost push causes. We have the Fed's successful fight against demand. And now we have this new tariff uncertainty. Where does all that leave us on the big question? Is inflation actually peaking? Or has it peaked?
Well, based on synthesizing all these sources, it's really not a simple yes or no answer. It's mixed. On the one hand, you have clear signs that the rate of price increases has definitely slowed down from those really high peaks we saw in 2022. Overall, CPI is down to 2.3%, lowest in years. The SF Fed analysis shows the Fed really did succeed in crushing the demand part of inflation, which was a major driver. And we are seeing some gradual slowing in those really sticky areas, like the pace of rent increases, even if the level is still high.
Okay, so signs of progress. But the but.
The but is pretty significant. Core inflation is proving stubborn at 2.8%, showing underlying pressures persist. And those key categories that eat up big chunks of people's budgets, shelter, car insurance, eating out, just owning a car, they're still showing pretty hefty year-over-year increases. That makes the felt inflation rate much higher for many people.
Right. The lived experience versus the average number.
Exactly. And then you layer on these new potential upside risks, primarily the tariffs. The analysis from economists at Goldman Sachs and Facet suggests these trade policies could actually push inflation higher in 2025 than it would have been otherwise. So while the absolute peak rate of inflation seems behind us, the path ahead isn't necessarily a smooth glide down to 2%. New pressures could easily emerge and keep things elevated or even push them back up somewhat.
So it's not over.
It doesn't seem like it's completely over, no. Of course, a major economic slowdown or recession would probably bring inflation down much faster by killing off demand more broadly. But as the sources imply, that comes with its own very high price tag, especially in terms of job losses.
Okay, so the takeaway is less about a definitive peak and more about an evolving situation. Some pressures easing, new ones potentially building. Which brings us to maybe the most important part for everyone listening. If inflation is sticking around, maybe in different forms, what can you actually do about it? How do you protect your finances, your purchasing power? This is where it gets really practical.
Absolutely. And this is where we draw heavily on the advice from Investopedia, Bankrate, NerdWallet, focusing on tangible things you can do. We can break it down into sort of immediate personal finance actions and then some longer-term investment strategies to consider.
Okay, let's start with the personal finance side. What are the key recommendations?
The first step is really fundamental but crucial. Take a hard look at your spending, go through your budget line by line, where's the money actually going, and identify areas of discretionary spending, the wants, not the needs, where you might be able to trim back. Even cutting, say, 5% from non-essential categories can free up a surprising amount of cash over time.
So really scrutinize those subscriptions, the eating out, the entertainment.
Exactly. Now, one interesting piece of advice from NerdWallet seems almost counterintuitive at first. They suggest that if you are already planning to make a major purchase that you genuinely need, like your washing machine finally died, or you need a reliable car for work, the advice is actually not to delay that purchase, indefinitely hoping prices will fall dramatically, because, well, they might not. Prices are still generally trending up, even if slower. Instead, the focus should be on shopping strategically for that needed item now.
Okay, so don't wait forever for that washing machine price to drop because it might just keep creeping up. Buy it now if you need it, but be smart about how you buy it.
Precisely. Strategic shopping means actively hunting for value. The sources recommend things like choosing generic or store brands where it makes sense, often the quality is very similar, being diligent about using coupons, signing up for store loyalty programs, and using rewards credit cards effectively. If you have a card that gives good cash back on groceries or gas, use it for those things to effectively get a discount.
Smart. What else on the personal finance front?
Another big area is attacking fees. Look at your bank statements, your credit card statements. Are you paying annual fees, late fees, overdraft fees? See if you can switch to accounts or cards that don't have those fees. Or sometimes you can just call and ask for a fee to be waived, especially if you're usually a good customer. And NerdWallet had that great quote, "It's amazing how easy this is to renegotiate bills." Think cell phone, cable, internet, maybe even some streaming services. But the key part was, doesn't happen unless you call. Make it an annual ritual to call your providers, ask if you're on the best plan, mention competitor offers, ask for a loyalty discount. You'd be surprised what you can save.
That's a great tip, just making the call.
Definitely. Also, regularly audit your subscriptions. It's so easy to sign up for things and forget, or for companies to raise the price slightly over time without you noticing. Cancel what you don't use or need. And for the cash you do have saved, especially your emergency fund, make sure it's working as hard as possible for you. Look for high-yield savings accounts. Online banks and credit unions often pay way more interest than traditional big banks. Right now, with interest rates where they are, some of these high-yield accounts are actually paying interest rates that are beating the current overall inflation rate. That helps preserve the value of your cash.
So getting your savings out of that near-zero interest account is key.
Absolutely critical. And finally, on the personal finance side, the sources reiterate the importance of having that emergency fund. Especially with all this talk about potential economic slowdowns or even recession risks, having that cushion of 3-6 months worth of living expenses and easily accessible cash is just vital. Yes, inflation erodes its value slightly over time, but the security it provides if you lose your job or have a big unexpected expense is worth far more.
Solid advice. Okay, so that's managing cash flow, spending, saving. What about investing? How can investment strategies help protect against this ongoing inflation?
Right. Investing offers the potential for your money to actually grow faster than inflation over the long term, or at least hold its value better during inflationary periods. Investopedia, in particular, goes into several different asset classes that are traditionally thought of as potential inflation hedges. But the key principle always with investing is diversification. Don't put all your eggs in one basket. Spread your risk around.
Okay, so what are some of these potential inflation hedging assets?
Well, the classic one everyone talks about is gold. Historically, people have flocked to gold during times of uncertainty or high inflation. It's seen as a store of value, an alternative currency, something physical outside the traditional financial system. However, Investopedia rightly points out it's not a perfect hedge. Gold prices can be volatile on their own, and critically, gold doesn't pay you anything, no interest, no dividends. So when interest rates go up, other assets that do pay a yield, like bonds, become relatively more attractive, which can sometimes hurt the price of gold. You can invest in physical gold, or more commonly through ETFs like GLD, the SPDR Gold Shares ETF.
Okay, gold. What else?
Commodities. This is a broad category, I think raw materials. Crude oil, natural gas, metals like copper and aluminum, agricultural products like corn, wheat, soybeans. Commodities have this unique relationship with inflation because they're the basic inputs for so many things we buy. When commodity prices rise, it often signals that consumer prices will rise later, that cost push effect again. You can get broad exposure through ETFs like GSG, the iShares S&P, GSCI Commodity Index Trust. The big caution here, though, is that commodities are super volatile. Prices swing wildly based on global supply and demand, geopolitics, weather, lots of unpredictable factors.
Right, not for the faint of heart. What about real estate? We talked about shelter costs driving inflation.
I guess.
And owning real estate help.
Real estate is generally considered a pretty strong inflation hedge, yes. Both owning property directly and investing through things like REITs. The idea is that property values tend to rise with inflation over the long term. And if you own rental property, you can typically increase rents over time to keep pace with rising costs and general price levels. Investopedia actually calls owning rental property for income one of the best ways to hedge against inflation.
But being a landlord isn't for everyone. What about REITs?
Exactly. For people who want real estate exposure without the hassle of tenants and toilets, real estate investment trusts, or REITs, are an option. These are basically companies that own and operate income-producing properties, shopping centers, apartment buildings, office towers, warehouses, etc. They're legally required to pay out most of their taxable income as dividends to shareholders, so you get regular income tied to real estate performance. ETFs like VNQ, the Vanguard Real Estate ETF, give you diversified exposure to a whole bunch of REITs.
Sounds good. Are there downsides to REITs?
There are. Like gold, REITs can be sensitive to rising interest rates. When Treasury bond yields go up, they offer a safer source of income, which can make REIT dividends look less attractive by comparison, potentially hurting REIT prices. Also, property taxes are a cost for REITs, just like for direct owners, and those can go up, eating into cash flow. And one more thing. Those nice high dividends from REITs are usually taxed as ordinary income, not the lower qualified dividend rate you get from many stocks. So the tax bite can be bigger depending on your bracket.
Good points. Okay, what other investment hedges are mentioned?
There's a specific type of government bond called TIPS, Treasury Inflation Protected Securities. These are designed explicitly to protect you from inflation. How they work is the face value of the bond actually adjusts up or down based on changes in the CPI. So if CPI goes up, the principal value of your TIPS bond increases. If we had deflation, falling prices, the principal would decrease.
And the interest payments?
TIPS, yes, pay a fixed interest rate, but that rate is applied to the adjusted principal. So as inflation pushes the principal value up, the actual dollar amount of interest you receive also goes up. It directly links your return to inflation. You can buy TIPS directly from the Treasury in 5, 10, or 30-year maturities, or through ETFs like TIP, iShares TIPS Bond ETF, SCHP, Schwab US TIPS ETF, or TDTT for shorter durations.
Are there risks with TIPS?
Yes. If you experience deflation, the principal can fall, though you're guaranteed to get at least your original principal back at maturity. Also, you might owe taxes each year on the increase in the principal due to inflation, even though you don't actually receive that money until maturity, or you sell the bond, this is called phantom income, unless you hold TIPS in a tax-advantaged account like an IRA. Unlike regular bonds, if you sell a TIPS bond before it matures, its price can fluctuate based on changes in overall interest rates.
Okay, TIPS seems like a very direct inflation hedge. Anything else?
One more category mentioned is leveraged loans, sometimes packaged into things called CLOs, collateralized loan obligations. These are basically loans made to companies that are already pretty heavily indebted or have lower credit ratings, risky companies. The key feature that makes them a potential inflation hedge is that they almost always have floating interest rates. That means the interest rate the company pays adjusts periodically, usually based on a benchmark rate like SOFR, which tends to move with overall interest rates. So as inflation pushes interest rates higher, the income you receive from these loans tends to go up too. An ETF like BKLN, the Invesco Senior Loan ETF, provides exposure. The main risks here are obviously the companies defaulting on their loans, credit risk, the loans potentially being hard to sell quickly, liquidity risk, and they often have fewer protections for lenders than traditional bonds.
Interesting. So several specific asset classes potentially offer some hedging. What about just standard investments? The sources mentioned things like a 60-40 portfolio, the S&P 500, the broad bond market. How do they fit in?
Yeah, Investopedia mentions these common benchmarks, but doesn't really frame them as primary inflation hedges in the same way as gold, commodities, real estate, tip PS, or leveraged loans. The traditional 60% stock, 40% bond portfolio is described as, a standard, relatively safe approach compared to being all in on stocks. But the source notes it will likely underperform an all-stock portfolio over the very long haul because of less growth potential. And that 40% bond allocation can get hurt when interest rates rise during inflationary periods. DGSIX is mentioned as an example fund.
And the S&P 500, just owning the big U.S. companies.
Right, the S&P 500, tracked by ETFs like SPY, it gives you exposure to large U.S. stocks. Now, over the very long term, stocks have historically provided returns that beat inflation. So owning stocks is crucial for long-term wealth building despite inflation. But the source doesn't position the S&P 500 itself as a specific short-term hedge against inflation spikes in the same category as the others. It also notes drawbacks like it being dominated by the very biggest companies and lacking exposure to potentially faster-growing small-cap stocks.
Okay. And the general bond market index, like AGG.
Similar story. The Bloomberg Aggregate Bond Index, tracked by AGG, covers a wide range of U.S. investment-grade bonds, government, corporate, etc. But the source points out it's heavily weighted towards the entities that issue the most debt, like the U.S. government, and isn't necessarily well-diversified across different types of bond risks. Again, not presented here as a dedicated inflation-fighting strategy, and bonds generally suffer when rates rise.
Got it. Any other miscellaneous things mentioned?
Just briefly, the sources touch on whole life insurance. The guaranteed cash value part offers very little inflation protection. The dividends some policies pay might offer a partial hedge if they increase over time, but it's not their primary purpose. And there's also inflation protection riders you can get on home insurance policies. These automatically increase your coverage limits over time to try and keep pace with rising rebuilding costs, which is important.
Okay, so wrapping up the strategy section. It sounds like protecting your purchasing power is really a two-pronged approach. On the personal finance side, get disciplined about tracking spending, shop smart, kill unnecessary fees, make your savings work harder in high-yield accounts, and absolutely keep that emergency fund topped up. And on the investment side, consider strategically adding some potential inflation hedges like gold, commodities, real estate, or REITs, tips, maybe even leveraged loans into your already diversified long-term portfolio, understanding the specific risks and characteristics of each.
That's a perfect summary. It's about being proactive and informed, using the tools and strategies available, both for your daily money management and your long-term financial health, based on the insights from these sources.
This has been a really comprehensive deep dive. We've covered a lot of ground trying to understand U.S. inflation and exploring ways you can protect your purchasing power. Just to synthesize quickly, inflation is definitely real. We can measure it. It eats away at our money's value, and it has those real psychological costs, too.
And we saw the Fed has been, historically successful, actually, in using its main tool, interest rates, to cool down the demand side of this inflation equation. That's played a big role in bringing the headline rate down. But those underlying price pressures are still proving sticky, especially in big budget items like shelter, car costs, eating out. That's keeping core inflation elevated.
Right. And crucially, we have these new potential wild cards entering the game, especially the uncertainty around tariffs and trade policy. Some analysis suggests these could actually push prices back up again, adding this whole new layer of complexity.
But the encouraging part, really emphasized by the sources, is that you're not just a passive victim here. There are concrete, practical things you can actually do. From being really vigilant about your spending and saving habits to exploring these specific investment strategies that are designed or at least have characteristics that might help your money keep pace or even outgrow inflation over time.
So the key takeaway here isn't about finding some single magic bullet or perfectly predicting the future of prices, which is impossible anyway. It's more about understanding the different forces at work, recognizing that your personal inflation experience is probably unique to you, and then thoughtfully implementing a combination of smart personal finance habits and considering these diversified investment approaches that might offer some protection against that erosion of purchasing power. It's an ongoing effort, right? Constant awareness and adaptation.
Absolutely. And maybe a final thought to leave you with, building on what we discussed from the sources. We talked about how your personal inflation rate depends so much on your specific spending. That really underscores the need for personalized financial planning. We also saw hints that people's perception of inflation, that strong gut feeling about it, might be driven by more than just the percentage change. Maybe it's the high level of prices now compared to a few years ago that really bothers people, even if the rate of increase slows down. Or maybe we focus on the pain of rising prices and underestimate how inflation can, strangely enough, reduce the real burden of existing fixed-rate debt over time.
That's interesting. The psychology versus the pure numbers. So as you, our listener, think about your own financial situation after hearing all this, maybe the most important thing is to look beyond just the official CPI number. Really dig into how inflation is truly impacting you, your budget, your goals, your feelings about money. Because understanding that personal reality, that's probably the essential first step in choosing which of these strategies we talked about today will actually make the biggest difference for you in preserving your hard-earned purchasing power moving forward.